Okay, so let's continue with Chapter 7. What we need to do now that we've looked at all of the implications of purchasing a cash flow producing property from the perspective of the sponsor as well as a lender they'd obtain for this, we want to move into managing the property and maintaining the property. And now we're going to focus on the owner's perspective. And what we want to do is get to their cash flow after tax for each year of operations. And that's going to help us when we finally, after that, look at the implications of exiting, selling the property, getting all of the after-tax cash flows for the owner equity sponsor of this cash flow producing property. And then what are we going to do? We're going to get an NPV, and that will let us know whether or not this is a reasonable project. Okay, so let's go ahead and get started here. The first thing that we're going to want to do is create a set of pro forma financial projections. And what that's going to do is give us income and costs for each year for equity. So there are two ways to do this. We're going to use the basic method using cash accounting. So we'll project our before-tax cash flows to the owner. We'll see how to compute tax on the before-tax cash flows for each year, and that'll give us the ability to get our after-tax cash flows. And then what we want to do is for each year do a ratio analysis, look at some ratios which are measures of how well this cash flow producing property is performing for us. Um, we could do better using accrual accounting and some statistical and probabilistic measures. Those are topics for a future time. Okay, so we're going to start with operating cash flows to equity. In this case, those are for CMO. And we want to remember the basic things that we needed for the owner to even consider this operation. Um, we'll use the projection for the first year of operations, which is what CMO used to develop its cap rate purchase. And then we will use all this other stuff, okay, to help us project forward from the expected first year of operations for more years of operations. Um, and on the next page, we see how this is beginning to work. And by the way, everything that I'm showing you here is in the Chapter 7 spreadsheet. And in the next video, I'm going to walk through with you this portion of the Chapter 7 spreadsheet to make sure that everybody is clear on how to generate these numbers. And as you can see, there are a lot of them. Okay, so just as in the case for creating our cap rate based purchase where we had to project 1 year ahead, we're just going to do the same thing, but we're going to keep projecting all the way out to 5 years. The only thing that the company has changed here in terms of income and expense is that they initially, for purchasing the property, they assumed that the maintenance, operating maintenance, they'd have to put into the building, fixing roof leaks, recaulking windows, fixing the facade when it screws up, fixing pipes when they burst, that sort of thing, was equal to, in every year, 1/40th of the purchase price. So they've changed that now. That's way optimistic. They've changed that now to be a little bit more realistic. So they're saying that uh, non-capex maintenance is going to be 1/30th of the price of the building. And what I've got here in this area, in the amount of and percent growth area, I've got the information from our base assumptions that I'm going to need to project things forward. So, for example, CMO is assuming that the gross rent is going to grow every year by 8%. So 529,000 is equal to 490,000 times 1.8%. I'm sorry, times 1.08. And that then we take that 529, multiply that by 1.08 and get 571, etc., etc., etc. Okay. Um, and the vacancy rate is always going to be, in each year, 5% of the gross rent. Okay, so that's why you see it increasing there. 33,000 is approximately 5% of 666,000, and that 5% ratio holds for every year. Similarly, other income they think they're going to get from the property is going to be 6% of the gross rent in that year. And you should, with a calculator, check some of these numbers to make sure that you're comfortable with them. Don't just do it in Excel. Get out a calculator, check a few, make sure you agree. And then our EGI, key number, expected gross income, sometimes also called effective gross income, is going to be our gross rent minus our anticipated vacancy rate. Gross rent is, of course, assumes no vacancies at all, plus our other income. So we do that little summation and we get our EGI for each of our 5 years that we're projecting. Remember, they're planning to exit at the end of 5 years, so that's why we're only projecting 5 years. And now we go down to expenses. We have our property tax, which they've estimated at $1.14 per square foot, okay? And they're assuming every year that that property tax is going to grow by 7%. So here's what they've got in the first year, which is exactly what they had for the cap rate purchase. And that just comes from the total square foot of the building, which you'll have to look up, but it's in the spreadsheet and it's in prior slides. And the 41,000 here is just 1.07 times the 38,000, and et cetera, et cetera, et cetera, for all 5 years. Similarly, we have the insurance, which they're estimating on a per square foot basis. They're assuming that's going to grow 7% a year. Utility costs, they're assuming they're going to grow 7% a year. They have a superintendent who, as we know, is part-time, and they're assuming that her salary is going to grow by 7% a year. And as I said, the maintenance is starting out, the maintenance per year, at 1/30th of the purchase price. That's the 127,067. And then beyond that, they're assuming that the maintenance costs are going to go up. Good assumption. right? By 7% a year. So the 136,000 here is equal to 1.07 times 127,000. Again, strongly recommend you get out a calculator, check a few of these numbers to make sure you understand what's going on with these projections. Okay, and if I can find my cursor, there we go. We can keep going here. All right, so once we get our EGI and subtract our operating expenses, including non-CapEx maintenance, we have our NOI, all right, which is great. And now I'd like to get to before tax cash flows for the owner. So before tax, there's only one other thing left for them that they have to pay out every year, and that's, of course, their mortgage payment. And as we found in the previous module, their uniform mortgage payment is 89,000 and change each year. Okay, so we take their NOI and we subtract the mortgage payment, and this is the before tax cash flow to the owners of the building. Okay, so we'll keep going. Now we're ready to consider the tax on operations. And when we're doing cash accounting basis, which is all we're going to do this semester, the way that the IRS works it is they let you start with your NOI, okay, which is good because everybody computes NOI. So you start with NOI, and then they let you adjust it for simple projects like this in two ways. Remember we talked about that depreciation expense, which really has no basis in economic reality. The IRS lets you take that depreciation expense, and you see how it's constant here in every year? Remember what we determined that depreciation expense was, and this is established by the IRS through Congress, right? Um, it is in each year you can declare a depreciation expense of 127.5th of the initial cost of the building. Okay. Um, and again, that is supposed to be in accounting, that's supposed to measure the wear of a capital asset like a truck or something like that. And as we know, for multifamily rental buildings, they may be around for 80 years, 100 years, 150 years. If we go to Europe, 400 years, 500 years. So this whole depreciation thing is kind of a fiction, but it's in there to help owners of cash flow producing real estate properties. Why? Because if we take the NOI, which is 284,000, we subtract 153,000 from it, we're going to wind up with a much smaller number that we have to pay tax on. So it's a very great benefit for cash flow producing property owners. And the other thing that the IRS lets you deduct before you get to what you're going to have to pay tax on is your interest expense for the year. Okay, so for each year, I've got my interest expense. Notice how these are not constant, okay? And also remember where we got these numbers from. Where did we get the interest that had to be paid every year? That was in the owner's roll forward mortgage table that had for each year beginning balance of the mortgage unpaid, okay, and it had the mortgage payment for that year, which in this case was constant, 89,000, and then in each year it had the portion of that that was interest, and the interest was the beginning of period balance to be paid off times that 10% interest rate. And then the remainder of the 89,000 payment that isn't used for interest is the amortization amount. So we got these interest numbers from that table. The interest numbers are going down because the principal amount uh, that is being whittled down each year, which is always true for an amortizing loan. And we always pay interest on the remaining principal. So the interest is going down. Okay, so I strongly urge you to look up that table to verify these numbers. So now we again do another summation here. Our NOI minus our depreciation minus what we paid in interest gives us what the IRS calls taxable income. Sort of kind of like what we would call earnings before tax in GAAP accounting. Um, and then we just need to know the tax rate for the owners if this is an LLC because they're going to pay tax on their individual tax returns, or for the entity itself if this is a C Corp. And in this case, as we know, CMO is an LLC, and the owners are in the 25% tax bracket. So we're assuming they're going to pay 25% tax on this. This is just federal, but that's sort of a long story. Let's leave it as just federal for now. Um, and so 25% of 47,000 is roughly 12,000. 25% of 72,000 is 18,000, et cetera, et cetera, et cetera. So that's the taxes. Okay. So now what are we going to have to do next? Looking ahead, what we're always interested in is net comprehensive cash flows, right? Whenever we're doing discounted cash flow valuations of projects. So we had before, I know this is complicated, but this is the simplest example I could construct that is in any way realistic. We need to go back to, whoops, sorry, it's on this page, the before tax cash flow to the owners. Now, what are we going to do? We're going to subtract the tax, and that's going to be the after-tax cash flow. And that's what we'll be able to use in our discounted cash flow evaluation methods, NPV, and we'll do IRR in this case too. Okay, so we got our taxes, we got our before-tax cash flow, and now we just subtract our taxes from the before-tax cash flow to owners, and we get our after-tax cash flow to owners. Whew, okay. The important to keep your wits about you here. Depreciation is not included in the computation of before tax cash flows because there is no cash flow associated with depreciation. Okay. All right, so now that we've got that, the other thing that CMO is going to want to do while they're managing this project is they're going to, of course, want to monitor the financial performance as they go along. As you move on and when you take financial modeling courses and advanced real estate valuation courses, you're going to learn some tools that are highly sophisticated for doing this, such as Argus, commercially available real estate tools that virtually every property manager uses. But there's a lot of stuff that you can do which is very helpful just with the cash basis numbers that we've created so far. And I would argue you should always do these, even if you're using something like Argus. Make sure Argus is a very complicated program. Make sure that the numbers you're getting from Argus are making sense. And it's a good way to do that fairly simply. Okay, so what are the ratios you'd want to use to help monitor the performance? We've just got 5 of them here. There are more you could use, but these are 5 pretty good ones. Okay, so rent received over gross rent is 95% every year, okay? And gross rent would be, does this 95% number make sense? You always want to be checking, you always want to be asking, do these numbers validate my assumptions for my model or not? So let's think about this a little bit. So we've got our gross rent every year, and the vacancy rate is 5% every year. So it does make sense in this model that the rent received over gross rent is going to be 95% with that 5% vacancy rate. So that's looking good. Very common ratio to look at every year is our net operating income divided by our effective gross income. And you can see here that this number, this ratio is increasing. First of all, it's pretty high, which is great, okay, but remember that doesn't include our mortgage payment. And so you'd want to look at this and say, well, I compute these numbers for every year and it's increasing. Why is it increasing? Well, let's go back to the page where we computed our NOI and look at it. Really, the primary reason for this is that we're assuming our gross rent is growing by 8%, and virtually all of our expenses are only growing by 5%. Okay, so when we take this ratio of the NOI growing by 7% divided by the EGI, which is growing at 8%, we are going to get an increasing ratio. And this is also where you might want to say, you know, well, maybe CMO's being too optimistic about this. Can we really expect these ratios to be growing? Something to think about, which I don't have time to answer right now, but happy to discuss in class or online in the forums. Okay, another one very good to look at is interest over EGI, over effective gross income. How much of your effective gross income do you have to lop off right away to pay your interest? Remember, you have to lop that off right away, or what's going to happen? You're going to be foreclosed on. Okay, so you don't want this ratio to be too big. You want to make sure that you're going to be able to pay it. And so we have 17%. That's looking very reasonable because remember they have such a small loan here. They have a loan based on 20% loan to value, so they're pretty safe as far as their interest payments go. And so the key thing to note here is that this number is going down, okay? And why is this number going down? Well, we know that interest is going down each year because the principal balance of the unpaid mortgage is going down each year. And at the same time, the EGI is going up every year, right, by 8%. So we would expect this number to be declining, and it is. Another very important thing to do. It's not good enough to just make the numbers. You always want to look and say, does this trend make sense? Yes or no? Okay. Just make the cursor a little more visible here. There we go. Next step is after-tax cash flow over EGI, effective gross income. This is the key one for the owners, right? We've got it fourth in the list, but it's probably the most important of all the ratios for the owners. It's so important that I'm going to go ahead and underline it for us here. Okay. All right, and you see that this is increasing, okay? And that's again because we have our EGI growing faster than our expenses. So we would expect this to be increasing. And look at this. This is, it's a pretty awesome number, right? Just almost 40% you get in after-tax cash flow of your effective gross income. That's one of the reasons why real estate is cash flow producing real estate properties are very attractive. Okay, and the tax over taxable income here, I just put in as a check. That should definitely be 25%, right? If we say that our taxable income is going to be taxed by 25%, if we take the ratio of tax over taxable income, it better be 25%. So that's just another sort of common sense, did I make a mistake in my model type of thing to check. Okay, so like I said, in advanced classes, you'll learn many more performance metrics to look at. But I think if you look at these five, you can get a good answer to the question, is my basic model making sense? And also, are my assumptions making sense? Are they really viable? And I would sort of argue these assumptions are a little optimistic. Okay, so I think I've hit all these points, so we'll keep going here. Um, and just a reminder now, our finance objectives for evaluating cash flow producing properties, both the operator and the lender ultimately want to make a go, no-go decision, right? And the operator to do this, operator being equity sponsor, um, they're going to need to know their opportunity cost of capital for this type of project. They're going to have to get their comprehensive after-tax cash flows. And we're almost there right now. We have the cash flow required for the owner to purchase the property. We have the after-tax cash flows for operating the property for the 5 years they're planning to hold this property. And the only thing that's remaining is we have to get their after-tax cash flow for when they exit, for when they sell the property. That's going to be our next piece. They have to have a risk strategy, which essentially is built into their opportunity cost of capital. Um, and they want to compute these ratios, which we just did. And then next after that, we'll be computing the NPVs. Um, the lender, we're done with the lender. We finished with the lender when we set up the purchase and got the mortgage. And then the lender, to evaluate this project, needed to know her opportunity cost of capital, which she felt was about 10%. And we needed to get her comprehensive cash flows, including fees, which we did. And we need to know her risk strategy, and her risk strategy is built into the 10% opportunity cost of capital and the loan to value she set, which was only 20% for these folks. And then we computed her IRR for everything, including fees, was 10.4% above her opportunity cost of capital. So that was great. Um, so what I'm going to do is leave it there, and the next module is going to cover pretty much exactly what we just did here in the spreadsheet. And I'm just going to make sure that we can all compute all the numbers in this section in the spreadsheet. Um, so with that in our pocket, I'm going to say adieu for now.